Two data points were released this week that should never appear in the same economy at the same time. The first was GDP. The Atlanta Federal Reserve's GDP Now tracker, which had been projecting first quarter growth above 3% as recently as early March, collapsed to just 1.6% by April 2nd. Real economic output in the final quarter of 2025 came in at just 0.7% annualized. The economy is stalling. The second was inflation. Core personal consumption expenditure, the Federal Reserve's preferred inflation measure, came in at 3%. The New York Federal Reserve's Consumer Expectations Survey showed one-year inflation expectations surging to 4.2%, the largest month-over-month increase since the post-pandemic supply chain crisis. Bank of America revised its headline inflation forecast upward by 80 basis points to 3.6% for 2026, explicitly citing the Iran war as the catalyst. RBC Economics projects core inflation remaining stubbornly above 3% for most of the year. Prices are accelerating. Growth is decelerating. And both of those things are happening at the same time. That combination has a name. It is the one word that the Federal Reserve fears more than any other in the English language: stagflation. And the data released this week confirms that it is not a theoretical risk being debated by economists. It is a documented condition that is actively present in the American economy right now. And if you do not understand what stagflation means for your savings, your investments, your mortgage, and the value of every financial asset you own, you are about to learn the hardest way possible. Stay with me, because what I am about to walk you through is the exact mechanism by which stagflation destroys wealth, the historical precedent that proves it, the data that confirms it is happening today, and the specific actions that protect you from it. This is the most important financial concept most Americans will encounter this year. Let me start with why stagflation is the Federal Reserve's nightmare scenario, because understanding the trap requires understanding why the Fed cannot escape it. In a normal economic downturn, the Fed has a playbook. Growth slows. The Fed cuts interest rates. Lower rates make borrowing cheaper. Businesses invest. Consumers spend. The economy recovers. The playbook has worked reliably for decades. In a normal inflationary environment, the Fed has a different playbook. Prices rise. The Fed raises interest rates. Higher rates reduce borrowing. Spending slows. Demand falls. Prices moderate. That playbook has also worked reliably. Stagflation breaks both playbooks simultaneously. Growth is slowing, which demands rate cuts. Inflation is rising, which demands rate hikes. The Fed cannot do both at the same time. If it cuts rates to support the economy, it pours fuel on the inflation fire. Prices rise faster. Consumer purchasing power erodes. The very people the rate cut was supposed to help are hurt more by the inflation it unleashes. If it raises rates to fight inflation, it crushes an economy that is already stalling. Businesses stop hiring. Consumers stop spending. The recession that everyone fears becomes inevitable. And if it does nothing, which is what it has been doing, both problems get worse simultaneously. Growth continues to decelerate while inflation continues to accelerate. The economy deteriorates from both sides at once. This is the structural bind that the Federal Reserve is facing right now in April 2026. The federal funds rate sits at 3.5 to 3.75%. The Fed held rates steady at its March meeting and is widely expected to hold again at the April 28th through 29th meeting. Bank of America now expects at most 2 rate cuts in the fourth quarter of 2026, with explicit acknowledgement that those cuts may not materialize at all. Goldman Sachs concurs. The market had priced in 2 to 3 cuts by mid-year at the start of 2026. The Iran war eliminated that path in a matter of weeks, and the leadership transition compounds the uncertainty. Powell's term expires in May 2026. His expected successor, Kevin Warsh, has not publicly commented on policy since oil prices surged past $100. A new Fed chair navigating a stagflationary environment in their first weeks in office is a wild card that every institutional investor is pricing into their positioning. Now let me show you the specific data that confirms stagflation is actively present, not approaching, not theoretical, but measurable in the current economic data. GDP growth in the fourth quarter of 2025 came in at 0.7% annualized. That is less than half the prior estimate of 1.4%, and dramatically below the 2023 average of approximately 3.1%. The Atlanta Fed's GDP Now tracker for the first quarter of 2026 has been revised sharply downward from over 3% to just 1.6%. Bank of America revised its 2026 U.S. growth forecast down to 2.3%. Oxford Economics modeled a stress scenario with GDP at just 1.4%. RBC Economics projects growth running below the typical 2% trend for most of the year. Every major forecasting institution has revised growth downward since the Iran war began in late February. Simultaneously, inflation is moving in the wrong direction. Core PCE at 3% is a full percentage point above the Fed's 2% target. The shelter component of inflation is running at 3.6% annually. Food prices are projected to increase another 4 to 6% in 2026. Oil prices spiked above $119 per barrel in March and remain structurally elevated due to the Strait of Hormuz disruption. Bank of America raised its headline inflation forecast to 3.6% for the year. RBC sees core inflation remaining above 3% for most of 2026. The tariff rate has increased from 2.6% to 13%, adding persistent upward pressure to import prices that the Congressional Budget Office says will be borne 95% by American consumers and businesses. The University of Michigan Consumer Sentiment Index fell to 53.3 in March, a level historically associated with recession. Consumer confidence is not merely declining, it has collapsed. And the March survey captured responses that were all received after the Iran conflict started, meaning the full psychological impact of the war is embedded in the number. Consumers planning to spend on services shifted dramatically from yes to no. Vacation plans dipped, restaurant spending declined, and the share of consumers saying a recession is very likely rose again. Now let me give you the historical parallel that makes these numbers genuinely alarming. Because the last time the American economy experienced true stagflation, it produced the most devastating period of wealth destruction for the middle class in the 20th century. The 1970s, the oil embargo of 1973. OPEC cut production and imposed an embargo on nations supporting Israel during the Yom Kippur War. Oil prices quadrupled in a matter of months. The American economy, which had been running hot with elevated inflation from Vietnam War-era spending and Great Society programs, was hit by a supply shock that simultaneously raised prices and crushed economic output. Inflation peaked above 12%. Unemployment rose above 9%. GDP contracted. The stock market lost nearly 50% of its value in the 1973 to 1974 bear market. The traditional 60-40 portfolio was devastated because both stocks and bonds lost value simultaneously. The exact outcome that stagflation produces, because rising inflation destroys bond prices while stalling growth destroys equity prices. The Fed, under Arthur Burns, made the crisis worse by cutting rates prematurely to support growth, which reignited inflation and produced an even deeper stagflationary spiral. It was not until Paul Volcker took over in 1979 and raised rates to nearly 20% that inflation was finally crushed, but at the cost of back-to-back recessions and unemployment above 10%. The parallel to 2026 is uncomfortable. The oil shock is the same mechanism, a Middle East conflict disrupting global energy supply. The fiscal backdrop is similar, massive government deficits that are themselves inflationary. The Fed is similarly trapped between cutting rates to support growth and holding rates to fight inflation. And the consumer, stretched thin by years of elevated prices, is similarly positioned as the person who absorbs the cost from both sides. But there is a critical difference that makes 2026 potentially worse in one specific dimension. In the 1970s, the national debt was a fraction of GDP. The government had fiscal room to maneuver. Today, the national debt is $39 trillion. Interest payments exceed $1 trillion annually. The Congressional Budget Office projects interest costs will reach $2.1 trillion by 2036. The government does not have the same capacity for fiscal intervention that it had 50 years ago. And the Federal Reserve's balance sheet at $6.7 trillion is so large that additional quantitative easing would risk further inflating asset prices and fueling exactly the inflation it is trying to control. Every major bank and research organization is now using some variant of stagflation language to describe the 2026 outlook. The differences between institutions are in severity, not in direction. Bank of America calls it the war dividend. RBC calls it stagflation light. Oxford Economics models the worst case's GDP at 1.4% with inflation at 7.7%, and the world in outright contraction. The base case, across most institutions, sits closer to RSM's stagflation light baseline, U.S. growth at 2.2%, inflation above 3%, and rate cuts pushed back to the fourth quarter at the earliest. The misery index, the sum of unemployment and inflation, currently reads approximately 7.3. That is not at the double-digit heights of the Volcker era. Powell himself said at the March FOMC press conference that when he uses the term stagflation, he always has to point out that it was a 1970s term at a time when unemployment was in double figures and inflation was really high. He is technically correct. This is not 1974. But the direction of both components is moving toward the conditions that define stagflation. Growth is decelerating towards zero. Inflation is accelerating above 3%. And the policy tools that would normally address either problem are unavailable because addressing one makes the other worse. Now let me tell you what stagflation does to specific asset classes, because this is where the destruction becomes personal. Stocks suffer in stagflation because corporate earnings depend on economic growth. When growth stalls, revenue growth stalls. When revenue stalls but input costs rise because of inflation, profit margins compress. Companies cannot pass all of their cost increases to consumers when consumers are already cutting spending. The result is lower earnings, lower margins, and lower stock prices. The S&P 500 has already fallen approximately 5 to 7% year to date. The technology sector, which depends on high valuations supported by low discount rates, is among the hardest hit because the Fed cannot lower rates to support those valuations, while inflation is running above target. The Bank of America Fund Manager survey showed that growth optimism collapsed from 39% to 7% in a single month. Equity allocations went to a net 37% overweight, down from 48%. The rotation out of growth and into defensive sectors, energy, industrials, consumer staples, is the institutional response to exactly this environment. Bonds suffer in stagflation because inflation erodes the purchasing power of fixed income payments. When inflation is running at 3 to 4% and your bond pays 2 to 3%, you are losing purchasing power every year. And when inflation expectations rise, bond yields must rise to compensate, which pushes bond prices down. The 10-year Treasury yield is hovering near 4.3%. Long-duration bonds have already suffered devastating losses since the zero-rate era ended. United States banks are sitting on $306 billion in unrealized losses on their bond portfolios. The traditional 60-40 portfolio, which allocates 60% to stocks and 40% to bonds, is the single most vulnerable portfolio construction in a stagflationary environment because both components decline simultaneously. Cash suffers in stagflation if it is held in accounts earning below the rate of inflation. A savings account paying 0.39%, while inflation runs at 3 to 4%, loses 2.5 to 3.5% of purchasing power annually. But cash held in high-yield accounts or treasury bills earning 3.6 to 5% at least keeps pace with or slightly exceeds inflation, preserving purchasing power while providing the liquidity to deploy when asset prices fall. The assets that historically perform in stagflation are the ones that the institutional investors are currently accumulating. Gold, which has a documented positive correlation with inflation and serves as a hedge against currency debasement, reached an all-time high of $5,595 in January, and it remains near $4,700, up nearly 50% year over year. Energy stocks, which directly benefit from the rising oil prices that drive the inflationary component of stagflation, are the best performing sector in the S&P 500 at plus 23% year to date. Commodities broadly are at their highest institutional allocation since April 2022. These are the assets that Wall Street is buying while it sells the assets that stagflation destroys. Warren Buffett's $373 billion in treasury bills is the ultimate stagflation positioning. He earns 3.6% risk-free while stocks and bonds both face downward pressure. He preserves capital while the purchasing power of uninvested cash erodes, and he maintains the optionality to deploy at dramatically lower prices when the stagflationary cycle eventually breaks, either through the kind of aggressive rate hiking that Volcker used in 1979, or through the resolution of the supply shock that is driving the inflationary component. So what do you actually do? First, recognize that the traditional 60-40 portfolio is the wrong construction for this environment. Both components face headwinds. Consider reducing long-duration bond exposure and replacing it with short-duration treasury bills or inflation-protected securities. Consider adding commodity exposure, gold, and energy positions that benefit from the inflationary side of stagflation. This is not about abandoning stocks entirely. It is about tilting your allocation toward the assets that perform when both growth and inflation are moving against you. Second, build cash at the highest yield available. High-yield savings accounts at 4 to 5%, treasury bills at 3.6%, money market funds that track short-term government rates. Cash in a stagflationary environment is not lazy money. It is defensive positioning that preserves purchasing power while every other asset class faces pressure from one side of the equation or both. Third, reduce exposure to the most rate-sensitive, growth-dependent, valuation-stretched positions in your portfolio. Technology stocks at 30 to 50 times earnings cannot sustain those multiples when the Fed is unable to cut rates and growth is decelerating. The institutional investors have already rotated. The equal weight S&P 500 is outperforming the cap-weighted version. The value growth spread has reached its widest since the dot-com collapse. The money is moving from the positions that stagflation destroys to the positions that stagflation rewards. Fourth, understand the timeline. The next FOMC meeting is April 28th through 29th. Powell's term expires in May. The Iran diplomatic deadline creates a binary risk event for oil prices. If diplomacy fails and oil moves toward $130, the inflationary component accelerates and rate cut hopes are destroyed entirely. If diplomacy succeeds and oil collapses to $80 or $85, the inflationary pressure eases and the Fed has room to act. Either outcome produces massive volatility. And being positioned before the outcome is determined, not after, is the difference between controlling your response and being controlled by it. Here's the truth that Jerome Powell himself acknowledged when he said the word stagflation at his March press conference, even as he dismissed its current severity. The data shows growth falling. The data shows inflation rising. The data shows the Fed unable to address both simultaneously. The data shows consumers pulling back. The data shows institutional investors rotating defensively at the fastest pace in 30 years. And the data shows every major forecasting institution using stagflation terminology to describe the 2026 outlook. Powell is right that this is not 1974. Unemployment is not in double digits. Inflation is not at 12%. The misery index is not at 20. But every component is moving in the direction of those numbers. Growth is approaching zero. Inflation is approaching 4% in expectations. The Fed is frozen. The consumer is exhausted. And the oil shock that triggered the original stagflation in 1973 has been replicated almost exactly by the Iran war of 2026. Complete with the same mechanism, Middle Eastern conflict disrupting global oil supply through the same waterways. The data that broke Wall Street this week did not break it because of a single number. It broke it because two numbers appeared simultaneously that should never coexist. Falling growth and rising inflation. The trap that no central bank has ever escaped without significant economic pain. The trap that destroyed the 60-40 portfolio in the 70s. The trap that the Federal Reserve has spent 50 years trying to prevent from ever happening again. And it is happening. The numbers are documented. The institutional response is verified. The historical precedent is unambiguous. And the only question remaining is whether you understood the trap before it closed, or whether you will discover what stagflation means for your portfolio the same way millions of Americans discovered it in 1974. By watching the value of everything they owned decline while the cost of everything they needed continued to rise. And let me give you the granular detail on exactly how the stagflationary pressure is flowing through the American household right now. Because the macro numbers obscure the lived reality that is far more severe than any single data point can capture. Grocery prices have increased 23% since 2020. The 2026 food price report forecasts another 4 to 6% increase this year. Beef has hit record highs exceeding $6.20 per pound. A family of four is spending nearly $1,000 more on food this year than last year. And 55% of American adults are now using credit cards as a primary financial lifeline to cover basic necessities like groceries, rent, and utilities. That is not discretionary credit card usage. That is survival spending on plastic at 22% interest. When more than half the population is financing food on a credit card, the inflationary pressure is not theoretical. It is destroying household balance sheets in real time. Gas prices surged above $3.48 per gallon nationally after the Iran war began. For a household with two vehicles and average commuting patterns, that translates to $100 to $200 per month in additional fuel costs. The Department of Agriculture reported food prices already up 2.9% year over year before the full diesel-driven supply chain cost increases flow through. Energy Secretary Chris Wright said publicly that the period of elevated energy prices would be temporary but would not be short. Even the administration acknowledged that this is not a one-week event. And every dollar diverted to gasoline and groceries is a dollar that does not go into savings, does not service existing debt, and does not contribute to the consumer spending that drives 70% of GDP. Credit card debt has reached a record $1.28 trillion, up 29% from pre-pandemic levels. The average interest rate exceeds 22%. 47% of cardholders carry a revolving balance. 61% of those with credit card debt have been in debt for at least a year, and 22% say they do not believe they will ever pay it off. Americans carrying five-figure balances of $10,000 or more jumped from 23% in 2025 to 29% in 2026. Total household debt reached a record $18.8 trillion. The average household carries $105,000 in total debt. The debt service ratio stands at 11.2% of disposable income. For every $10 earned, more than one goes directly to servicing debt before a single dollar is spent on necessities. The personal savings rate has fallen to approximately 4.4% year to date, below the 4.6% average of 2024 and far below the 10 to 15% that experts recommend. The median emergency savings balance dropped from $10,000 in 2025 to just $5,000 in 2026, a 50% decline in 1 year. 27% of Americans have zero emergency savings, the highest level ever recorded. 43% cannot cover a $1,000 emergency expense with savings. 53% are living paycheck to paycheck, including 32.3% of those earning over $100,000. This is the human face of stagflation. It is not an abstract economic concept debated in academic papers. It is a mother putting groceries on a credit card at 22% interest because her paycheck does not stretch far enough. It is a father watching his emergency savings decline from $10,000 to $5,000 in a single year because the gap between income and expenses has turned permanently negative. It is a family that planned to refinance their mortgage before rates climbed again, but the Iran war sent yields higher and the window closed. It is a recent graduate entering the workforce with student loan payments about to increase, while the job market softens and the cost of rent, food, and transportation continues to climb. And it is a retiree on a fixed income watching inflation erode their purchasing power, while the Federal Reserve cannot cut rates to provide relief because cutting rates would make the inflation worse. The institutional investors see all of this in their data. That is why the Bank of America Fund Manager survey showed the fastest sentiment reversal in 30 years. That is why growth optimism collapsed from 39% to 7% in a single month. That is why inflation expectations surged from 9% to 45%. That is why cash allocations jumped at pandemic speed. That is why United States equity allocations flipped to a net 17% underweight. That is why Warren Buffett is sitting on $373 billion in Treasury bills. They are not watching a different economy than you are. They are watching the same economy with better data, faster access, and the discipline to act on what the numbers are telling them. And what the numbers are telling them is stagflation, growth falling, prices rising, the Fed frozen, the consumer exhausted. The fiscal position of the government, too, compromised by $39 trillion in debt and $1 trillion in annual interest payments to provide meaningful stimulus. And the geopolitical shock of the Iran war adding energy-driven inflation on top of an economy that was already running too hot on the price side and too cold on the growth side. Goldman Sachs has raised its U.S. recession probability to 25%. Moody's recession forecasting model was at 49% before the full oil shock was incorporated. In every historical instance when that model crossed 50%, a recession followed within 12 months 100% of the time. And Mark Zandi, Moody's chief economist, stated publicly that if oil prices remain elevated for more than a few weeks, a recession will be difficult to avoid. The Fed's own stress test for 2026 models a scenario in which unemployment rises to 10%, housing prices collapse by 30%, and commercial real estate loses 39% of its value. That is not a fringe scenario. That is the Federal Reserve's documented contingency for the kind of economic deterioration that stagflation produces when it is left unaddressed. And the bond market is confirming the signal. The 10-year Treasury yield at 4.3% reflects real concern about inflation persistence, fiscal sustainability, and the credibility of monetary policy. Ray Dalio of Bridgewater has described the potential endgame as an economic heart attack with government investment crowded out by debt service obligations. When the founder of the world's largest hedge fund uses the phrase heart attack, when the chairman of the Federal Reserve says it will not end well, when every major bank uses stagflation terminology, and when the data shows growth at 0.7%. While inflation expectations hit 4.2%, the conclusion is not ambiguous. The Thursday data did not create the stagflation trap. The trap was being built for years through deficit spending, money supply expansion, artificially suppressed interest rates, and an economy that became dependent on conditions that could not be sustained. The Iran war and the oil shock merely revealed the trap by removing the illusion that inflation was under control while the economy was strong. The illusion is gone. The data is in. Growth is falling. Inflation is rising. The Fed cannot fix both. And the people who understood this before the data confirmed it are already positioned. The people who waited for confirmation are receiving it now. And the people who dismissed the signal because Powell said, this is not 1974 making the same mistake that the investors of 1973 made when they were told the oil crisis was temporary. The economy was fundamentally sound, and the central bank had everything under control. It did not. The stagflation of the 1970s lasted a decade. The wealth destruction was measured in trillions, and the people who were positioned for it, who held gold, who held energy, who held cash, who avoided the assets that stagflation destroys, were the ones who emerged with their purchasing power intact. The same positioning is available right now. The data says it is necessary. The institutions have already acted on it. The only question is whether you will act on it before the trap closes completely. Because once it closes, the Fed has no tools to open it. That is what makes stagflation the most dangerous word in economics. Not because it is rare, but because once it arrives, there is no easy way out. And there is one more dimension that most analysts are not discussing. The 1970s stagflation had a resolution mechanism. Volcker raised rates to 20% and crushed inflation at the cost of severe recession. The economy took the medicine. The pain was intense but finite. The current environment may not have that luxury, because the national debt in the 1970s was a fraction of GDP. The government could absorb the cost of high interest rates without facing a debt service crisis. Today, every 100 basis points increase in interest rates adds approximately $390 billion per year to the government's interest bill. Raising rates to the levels that would be required to crush inflation the way Volcker did would bankrupt the federal government. The interest payments would consume such a large share of the budget that Social Security, Medicare, defense, and every other program would face catastrophic cuts. The Volcker playbook is mathematically unavailable at $39 trillion in debt. And cutting rates aggressively, the opposite approach, is equally constrained. If the Fed slashed rates to zero to stimulate growth, inflation would surge. Consumer prices that are already rising at 3 to 4% would accelerate further. The dollar would weaken. Gold, which is already near all-time highs, would surge past 6,000. Oil, already elevated from the Iran war, would remain expensive because the supply disruption is physical and cannot be resolved by monetary policy. And the American consumer, who is already financing groceries on credit cards, would see the prices at the checkout line climb even further. This is why the institutional investors who see the data most clearly are not positioning for either rate cuts or rate hikes. They are positioning for policy paralysis, a Federal Reserve that does nothing because doing anything makes the situation worse. And policy paralysis in a stagflationary environment means the deterioration continues unchecked. Growth falls further. Inflation persists. Consumer purchasing power erodes. Savings deplete. Debt accumulates. And the economy slowly grinds toward the kind of reckoning that the Federal Reserve's own stress test is already modeling. The $930 billion in commercial real estate debt maturing this year adds another layer of vulnerability. Office vacancy rates above 20% mean many of those loans will default. Regional banks holding 70% of commercial real estate loans will absorb losses that reduce their capacity to lend. Tighter credit means fewer mortgages, fewer business loans, fewer consumer loans. The credit contraction amplifies the growth deceleration that is already underway. And the bank unrealized losses of $306 billion on securities portfolios compound the stress, because those losses were created by the same interest rate increases that the Fed cannot reverse without fueling inflation. Every piece of the puzzle connects to every other piece. Inflation prevents rate cuts. Growth deceleration prevents rate hikes. The debt prevents fiscal stimulus. The Iran war prevents energy cost relief. The commercial real estate maturity wall prevents bank balance sheet recovery. The credit contraction prevents consumer access to capital. And the consumer exhaustion prevents the spending that drives 70% of GDP. Each problem reinforces every other problem. And the resulting condition, growth falling while prices rise while the central bank is frozen, is the textbook definition of the trap that the Thursday data confirmed. The data broke Wall Street this week not because it revealed a problem that nobody knew existed. It broke Wall Street because it confirmed a problem that everyone knew existed but nobody wanted to price in. The stagflationary signals had been accumulating for months. The Iran war had been disrupting energy markets for weeks. The consumer data had been deteriorating for quarters. But as long as the numbers could be explained away individually, as long as each data point could be attributed to a temporary factor, the market could maintain the fiction that the economy was fundamentally sound. The Thursday data eliminated that fiction. It put both numbers side by side on the same release: falling growth, rising inflation, simultaneously. And the institutional response was immediate: cash allocations surging, equity allocations falling. The rotation into defensives accelerating. Because the institutions know what the data means. They know the trap. They know the history. And they know that once both components are confirmed, the market does not recover until one of them reverses. And neither component is showing any sign of reversing. The growth side will not reverse without rate cuts or fiscal stimulus, neither of which is coming. The inflation side will not reverse without the Iran war resolving and oil prices collapsing, which the Pentagon says is not happening until total defeat is achieved. And the Fed will not act until one side of the equation improves enough to give them room to address the other. That stalemate is the trap. The Thursday data confirmed it, and the market is now pricing for the possibility that the stalemate lasts through the rest of 2026. If that is what happens, the wealth destruction will not come from a single crash. It will come from the slow, steady erosion of purchasing power, portfolio value, and financial security that stagflation produces month after month after month. And the only people who preserve their wealth through that kind of environment are the ones who understood the trap before it closed and positioned themselves accordingly. The data says the trap is closed. The question is whether you are inside it or outside it.